Welcome to This Explainer. Have you ever actually wondered why mortgage rates just absolutely refuse to fall? Or why the stock market seems to completely randomly freak out every few months, even when all the news headlines are actually pretty optimistic? Well, you are definitely not alone. There is this massive disconnect right now between what we're being told and how the markets actually feel on the ground. So, if you really want to know why financial conditions still feel so incredibly tight, we have to look past the usual suspects. I mean it. The absolute biggest risk to the US economy right now, it's not the AI bubble popping, it's not trade tensions with China, and it's definitely not whoever happens to be sitting in the Oval Office. It turns out the real threat is actually something almost ridiculously boring, and it's hiding right in plain sight. Okay, let's dive into this. The answer to our mystery doesn't start in Washington, and it doesn't start on Wall Street. It actually starts all the way over in Tokyo. More specifically, it revolves around what is arguably the single most boring asset on Earth: Japanese government bonds. Because for the past 30 years, Japan has quietly been the financial duct tape holding the entire global financial system together. And right now, that duct tape is really starting to peel off. Section 1. Japan's Lost Decades, the Origin Story. To understand why a Japanese policy shift could literally wreck your portfolio, we really need to rewind a bit. So picture this. 30 years ago, back in 1992, Japan's massive asset bubble burst. Real estate collapsed, equities completely collapsed, and the country entered what everybody now calls the lost decades. We're talking about a 3-decade stretch of basically zero real growth, zero inflation, and zero wage expansion. It was honestly as if their whole economy hit the pause button and nobody could find the remote. Out of sheer desperation, the Bank of Japan cut interest rates to zero. Then they cut them below zero. And when that still didn't work, they introduced a pretty drastic measure. They essentially superglued interest rates directly to the floor. Now, this drastic measure was called yield curve control. Basically, this means the central bank forcefully caps long-term bond yields at a highly specific near-zero target, whether the market likes it or not. But just think about what this actually does to Japanese investors for a second. Imagine you're managing a Japanese pension fund, right? Or maybe a life insurance company. You have literally billions of dollars to invest, but your domestic government bonds are paying you exactly 0%. You really only have two choices. You either accept absolutely zero return on your cash, or you pack your bags and go shopping overseas just to survive. Section 2. The mechanics. The world's ATM. Obviously, those Japanese funds chose to go shopping. Japan's zero-rate environment forced all this domestic money out the door, and it fueled this massive multi-decade global shopping spree. Over time, Japan quietly transformed into the single largest foreign holder of U.S. treasuries, and basically became the world's ATM. And this brilliantly illustrates exactly how that global ATM worked. It's a classic strategy known as the yen carry trade. Let's imagine a giant global hedge fund instead of just a retail investor. Step 1, they borrow money in Japanese yen because the interest rate is practically zero. Step 2, they convert that yen into US dollars. Step 3, they take those dollars and buy US treasuries yielding, say, 4% or more. After paying some minor hedging costs and a few fees, the fund simply sits back and pockets the spread. I mean, it's essentially free money. But here's the crazy part. Global funds weren't just stopping at US treasuries, because when borrowing costs are practically zero, institutions will buy absolutely anything with a pulse that yields more than 0%. They bought mortgage-backed securities, massive amounts of tech stocks, real estate, emerging market debt, the whole shebang. At its peak, this yen carry trade reached into the trillions of dollars. It effectively acted as this invisible global Wi-Fi network powering the world's financial markets. But, of course, there was a catch. Section 3. When the math flips, the 2024 shock. This entire, massive, multi-trillion-dollar system relied on one incredibly fragile assumption. Just one. And that was the assumption that Japanese yields would stay near zero forever. But that assumption violently broke in 2024. For the first time in 17 years, the Bank of Japan totally shocked the world by officially ending yield curve control and raising interest rates. And then, shortly after, they raised them again. This was an absolute paradigm shift, and the markets practically had a heart attack. Right after that second rate hike decision, the US S&P 500 quickly dropped 6%. But over in Japan, wow, the Nikkei 225 plummeted over 12% in a single day. That was its worst single-day drop since 1987. Now, why the panic? Well, because when Japan raised rates, borrowing in yen suddenly became way more expensive. Hedging that currency risk became more expensive. The math completely flipped. That 4% treasury the hedge fund was happily buying, it was no longer a no-brainer free money trade. And when the math flips, the capital flows flip right along with it. This sparks a powerful process called repatriation. Basically, the mountains of money that flowed out of Japan for decades are starting to pack up their bags and head back home. Make no mistake, this is one of the biggest threats to markets today. The absolute cheapest source of global liquidity for the past 30 years is suddenly no longer cheap, and it is actively leaving the chat. Section 4. The Global Domino Effect, the Everything Story. So what does this all mean for you? Why does this matter to your portfolio? Or how does a banking policy shift in Japan somehow dictate your monthly housing costs? Well, Ray Dalio sums it up perfectly right here. He points out that the bond market is the backbone of all markets. It's the ultimate baseline interest rate that determines what every single asset globally is going to return. If the basic supply and demand for those bonds breaks down, well, interest rates absolutely have to rise. Now, we all know the media absolutely loves to hyper-analyze the Federal Reserve. They treat Jerome Powell's press conferences like they're dropping a highly anticipated movie trailer or something. But honestly, the Fed really only controls short-term overnight interest rates. The true power, the stuff that actually moves the needle, lies in long-term rates, the 10-year, the 20-year, the 30-year yields, and those are completely dictated by global supply and demand. So everyone staring at Jerome Powell is basically staring at the wrong lever. So the absolutely crucial point is this. We all know the United States is running massive trillion-dollar deficits annually. The U.S. Treasury has to constantly issue mountains of new debt just to keep the lights on around here. And for the last few decades, Japan was this incredibly reliable, totally price-insensitive machine, just automatically absorbing all that debt. So here's the million-dollar question. If Japan steps back and stops buying our debt, who actually steps in? Well, to attract new buyers, long-term bond yields simply have to go up. This creates what's called a steepening yield curve, and that kicks off a really nasty domino effect. When long-term yields stay elevated, stock valuations compress. Mortgage rates stay stubbornly artificially high. Housing remains completely unaffordable for average folks. Corporate borrowing gets tighter, which slows down overall business growth. This isn't just some abstract bond market story anymore, right? It literally becomes an everything story. At the end of the day, what you really need to take away from this explainer is that liquidity is quite literally the oxygen in financial markets. Right now, we are witnessing the historic unwinding of the largest carry trade in the entire world. As that Japanese capital slowly returns home, it is silently changing the cost of money everywhere. It is fundamentally reshaping the very foundation of asset valuations across the globe. So I want to leave you with this provocative thought. Financial media loves to talk about flashy headlines, tech stocks, and political drama, mostly just because it gets clicks. But the real threats to the financial system, they are rarely the loud ones. The loud ones are already priced in. The real threats are always the ones hiding in plain sight. What actually happens to the global economy when the world's largest foreign buyer of U.S. debt simply decides to stop buying? Thanks for joining me on this explainer, and definitely keep your eyes on that bond market.